How? Look at this. Bank stocks. Man, are they up since the election? 20% or more. Look at that. Citi, JP Morgan, Wells Fargo, Bank of America, huge gains. Come on in, the guy who called it. His name is Dick Bove. He is a bank analyst, the only analyst who ever appears on Fox on this particular program. You're here because you got it right. Okay, where are we going from here? We're going to go up some more on these bank stocks?
A lot more. I think it's almost impossible to mention to you all the positives that have developed, with this election. If we take a look at loan volume, we've got tax cuts, we've got spurring of manufacturing activity, maybe some fiscal stimulus. If we look at margins, we have slightly higher interest rates. If we look at, loan losses, the increase in the price of oil is going to result in a write-up of all the things that were written down about a year ago. If we're looking at the stock market, it means there's going to be a lot more merger and acquisition activity, a lot more underwritings done. If we look at, in essence, the movement of funds, trading activity will be much stronger. And at the same time, we're looking at breakthroughs in technology, which is lowering the cost of doing business, and we're looking at changes in regulations, which also lowers the cost of doing business.
It's the perfect storm, I guess. It's not a storm, but it's the perfect situation, I guess you could say.
Everything's going right.
We're going to put on the screen the 10-year Treasury yield, which is right around 2.5%. And that's way up since before the election. And on Wednesday, a lot of people expecting an interest rate hike from the Federal Reserve. Can you explain why interest rates going up is good news for bank stocks? Because a lot of people don't get that.
Well, historically it wasn't, right? In other words, historically, because 92% of the assets of a bank are financial assets. When you raise interest rates, you're lowering the value of those assets, and it's having a negative impact on the real equity of the bank, and that causes the stocks to go down.
Okay.
But in this case, interest rates are so low that before, if you will, that impact hits, if you will, the financial ownership of these financial assets, it's going to hit the earnings. And it's going to hit the earnings fairly significantly because basically no bank is going to increase the interest rates it pays you on the money that's coming in. And again, you're going to see trillions of dollars coming in if they repatriate these funds.
Wow.
But they are going to increase the rate on what they charge you for the loans.
Just to be clear, it's not like you're talking up your book, but you do own a lot of these bank stocks that you are recommending, and they are moving up. That is correct, right, Dick?
Yeah, virtually every stock you mentioned I own.
Okay. Now, we put up a screen as we started the interview of the huge bank stocks and the huge gains that they've already made. 20% plus. Do you see them gaining another 20% plus from here on out over maybe the next 6 months, year?
Yes, I do. I think, if you took that chart back a year and you compared it to the so-called FANG index and you threw a FANG index with Apple, these big banks have outperformed 5-to-1 against those technology stocks. And basically, these big banks are not anywhere near their earnings potential. In other words, because they have so much excess equity, so much excess liquidity, because there's so much business which is likely to come their way, 20% is a modest expectation for what's going to happen over the next year.
Oh, the animal spirits are among us this Monday morning, Dick Bove. You're a popular guy, if you get it right again, that is. Dick, thank you very much for joining us, and I mean it. Thank you, sir. We'll see you soon.
Thank you.